Hey everybody. No, damn it, it's not transitory. The Fed, led by generous Jerome Powell, is adamant that the current sharp rise in inflation is transitory. At the same time, there is still slack in the labor force, as seen in the labor participation rate, so they have to keep rates low for much longer. And Jay wants to keep his job, so he'll tend to do what the Biden administration wants him to do, which is to keep interest rates low for longer. But it's not possible for inflation to moderate, given, number one, the addition of almost $3 trillion in high-powered monetary base in just the last few months, an increase of $4.2 trillion, almost doubling federal expenditures to $9.1 trillion in just 1 year. An additional $1 trillion, who knows how much it's going to be, is going to be more stimulus coming in the next few months. Supply chain disruptions caused by COVID mandates, higher energy prices due to higher regulations, shutting down pipelines, and so on. There's many other reasons. The only thing stopping us from hyperinflation right now is the sharp drop in velocity of money of 90%. But that drop is over now. Velocity is now going sideways. So all the additional stimulus is going to go right into inflation right now. It's going to be contemporaneous. If they pump more money supply, more fiscal policy, it doesn't matter. That's going to go into inflation very, very quickly. Now, in the real world, of course, we have some prices are very volatile. Classically, we always talk about food and energy because, the price of oil can go from 40 to 80 and back to 40 in a few months. The price of rutabagas can double and halve in a season. So, classically, they leave out food and energy. Okay, fine. You want to look at it with food and energy, and you want to look at it without food and energy. But there's other types of prices that are sticky. In other words, once they get raised, they don't go down very often, if at all. Okay? So, for example, drug prices go up, they tend not to go down. Your doctor visit. Does your doctor cut his wages or his fees? Not very often. Not very often. So once we get to the place where some of these sticky prices are rising a lot, that's when inflation becomes baked into the cake. And now even tightening doesn't do a lot unless it creates a recession. One of the most important sticky measures is the Employment Cost Index, or ECI. It measures all the costs associated with labor in the U.S. So not only the wage rates, but also benefits and payroll taxes, et cetera, et cetera. So it encompasses everything that it costs to have somebody working in the society. So it was accelerated. It was at about a 2% annualized rate 4 or 5 months ago. Now it's up to 4.6% in just the last 6 months. And the chart is a straight line up. It's not struggling up. No, it's a straight line up. So the momentum of the ECI should lead us to expect something pushing 10% by the end of the first quarter of next year. And that 10%, or whatever number it is, let's say it's 8%, that's baked into the cake. And remember that the ECI is almost 2/3 of all prices. 2/3 of the economy are consumers. So that's the consumer spending. So this is the archetype sticky inflation indicator. Rarely does the ECI go down. It takes a significant recession like 2008 before you'll see the ECI go down. And we're not in a recession right now. We're not even close to a recession right now. The Fed is not tightening, so we're not going to have a recession anytime soon. Let's say at least through the first half of next year, maybe second half. But right now, because the Fed is so loose and global central banks are so loose, we're not going to have a recession anytime soon. And by soon, I mean in the next 9 months. So the ECI is going to basically lock in a CPI and PPI above 6% in the near term, and probably 10%, as I say, 8, 9, 10% by the end of the first quarter of next year. So, of course, the question is, how do we make money from this? Well, because I'm a professional trader, that's all I care about, right? So here's a couple of predictions that I have here. I think that we're going to start to see bonds start to go down again, long-term interest rates go up to take into effect the higher inflation. Stocks will remain strong because they're an excellent inflation hedge at the beginning part of an inflationary spiral. I think we're going to see housing prices continue to climb. Once again, as an inflation hedge, people will want to own houses. Wages, as I just discussed, are going to climb in nominal terms, but decline in real terms because inflation will go up faster than wages. That has a lot of political ramifications. When real wages are declining, people don't like whoever the bum is in power at that time. We're going to see consumer discretionary stocks gain on the rest of the market, and we're going to see another leg up in commodity prices. Now, every single week, I put out a weekly video newsletter called Wall Street Winners. The best place to get my specific trade recommendations is to subscribe. Just go to WSW2021.com. That's WSW2021.com. Your bank account will thank you.